Right then. Hello everyone. Welcome to the live lecture. How Forex works. Hey bro. How is everyone doing? You ready to learn something? This is going to be very, very in-depth. It's going to cover a lot of subjects. So what we're going to need are three things. 1, a pen. 2, a notepad. And 3, we need your undivided attention for the next hour to hour and a half. Okay? Ciao. So this is how Forex works. This is a guide to the fundamentals, everything that goes into Forex trading, the different types of traders, every single thing that goes into the price going up or down. We're going to discuss today, okay? I'm just going to give it a couple minutes, wait till 5 o'clock on the dot, and then we will get started. But don't forget to like the stream, guys. Subscribe if you haven't already, but like the stream up if you're ready for this. Buongiorno. Wagwan. Guten Tag. Alright then. So yeah. We'll give it 2 minutes. We'll just chill for a sec. And then we will get started. I'm going to put some music on in the background. Just some, lo-fi or something simple. Let me know if that's too loud, guys. So yeah, like the stream if you haven't already, guys. Like the stream if you're ready for this lecture. This is the free live lecture on how Forex works, a guide to the fundamentals behind Forex. Everything you need to know into what drives the price up and what drives the price down. Every single thing and how it works and why it affects the price. So we're going to get it started at 5 o'clock on the dot. So we've got about 30 seconds left. Make sure everyone who wants to be here is here, ready to go. And then we will get started. The first things we're going to be covering is just the simple definitions of a few basic things that you need to know. This is basically like the index to some words that I'm going to be using, which you may not understand. So we're going to make sure everyone's on the same page. We're going to have a quick PowerPoint, quick slide on all the simple definitions like pips and spread and stuff like that. But yeah, a lot has gone into this. This is going to be very informative. So let's get started. So the basics. So there's pips, which is a pip is the smallest price movement in a currency pair. It's used to measure price changes and profits or losses. So you'll notice when you have a take profit, it might be in pips or a stop loss in pips, or on MetaTrader, when I show you a trade that I've won or lost, it will say my entry and then the difference, and then the pips as well. So it will also say lots, which is the trade size in Forex. So you can have standard, mini, and micro lots, determining how much a pips movement impacts your trades. So lots is the measurement we use to actually get into trades. Pips is the measurement of price movement, basically. Now, leverage. Leverage allows traders to control large positions with a smaller amount of capital, increasing both potential profits and losses. So you can, the typical rule of thumb is 30 to 1. So you can have 30 leverage. You can, some brokers offer 100. Some prop firms do that as well. And in crypto, you can get 1 to 1,000 as well. The volume's low. Right, is this better now? Let me just turn the gain down. This should be better now. Let me know if this is good or too loud. We had this issue before, didn't we? Okay, right. So the bid ask price is the highest price a buyer is willing to pay. So bid is the highest price. The ask price is what you can sell a currency pair for. Yeah, it's better sound. The ask price is the lowest price a seller will accept. The bid price is the highest price, and the difference is the spread. Now the spread is the difference between the bid and ask prices and represents the transaction cost for traders. So when you get into a trade, you'll notice you'll automatically be down. Now this can be due to commissions, this can be due to spread. Most of the time it's due to spread. Now that's the profit that the market makers make, and we'll get into what the market makers are and all that stuff now. But that is the index. That's the simple shit out the way. We can now get into the good stuff. We can actually get into how Forex works. Now this isn't going to be showing you how to become a millionaire by using buys and sells. This isn't going to be showing you any of that bullshit. This is going to be showing you exactly what you need to know, regardless, like off the charts, off the technicals, none of the technical stuff. This is everything off of the charts that you need to know. But this is all the simple shit out of the way, so we can get started now. So, what is Forex trading? Forex trading refers to the global marketplace where currencies are bought and sold against each other. It operates on the exchange rate between currency pairs, where traders speculate on the value of one currency relative to another. So you can have the euro and the USD. That's the euro against the dollar. Then you have GBP JPY, which is what I trade, which is the GBP against the JPY or the yen. The Forex market is the largest and most liquid financial market in the world. It's open 24 hours a day, 5 days a week, with trading sessions spanning different time zones across the globe. So we can have London, New York, Asian, and Asian breaks down into Tokyo and Sydney session as well. So that's what Forex trading is. That's by definition. Now, the key points of Forex trading is that it is just currency pairs. It's a decentralized market, which means unlike stock exchanges like the Nasdaq and stuff like that, the Forex market is decentralized, meaning it operates through a global network of banks, institutions, and individual traders rather than a centralized exchange. So with stocks, you can get the Nasdaq, the S&P, the Dow Industrial Jones. They are all centralized because you're trading on the Nasdaq. Does that make sense? Whereas you might know this from TradingView. When you load up TradingView and you load up GJ, you load up USD, the Euro USD, there'll be different brokers. So you can have IC Markets, Pepperstone, Oanda, different charts of the exact same thing. That's because it's decentralized. It's each broker's representation of the same thing, kind of. Now, the purpose is for traders to engage in Forex either for speculation, which is profit seeking, or hedging, which is protecting against currency risk in international transactions. Now, what that means is you can deal in yen, you can get sales in yen, like I get sales in dollar, and obviously I live in the UK, I spend pounds. So what I could do if I was greedy, I could wait for the best transaction or the best price for me, the best, I don't know, forgot the word, fuck's sake, the best exchange rate, there we go. Market influences. Now, there's two main types really, but the currency values fluctuate based on economic indicators, geopolitical events like earthquakes, hurricanes, like you might have heard of a hurricane in Florida, interest rates, and global market sentiment, making it a dynamic and fast-paced trading environment. So that's the definition of Forex trading and the key points of it. These are the things that kind of separate it from everything else. Now, base and quote currencies. So inside of a Forex trade, we're actually looking at the pair itself by name. We're looking at the Euro USD, GBP JPY, AUD USD, any Forex pair. We're looking at the name now, okay? The name, what goes into that? Why is one currency at the start? What does it mean? Why is one currency second? What does that mean? In a Forex pair, two currencies are listed together. So you have the Euro and you have the USD, and their value is compared against each other. These are known as the base currency and the quote currency, okay? So the base currency is the first pair, which is the Euro in the Euro USD. And the quote currency is the second currency in the pair, which is the USD in the Euro USD. It reflects the price of one unit of the base currency expressed in terms of the quote currency. That might sound like a load of shit, but basically, if you go onto the Euro USD, you'll see it's probably whatever it is. Let's say it's 1.2, yeah? This means that €1 can be converted into $1.2. Okay, that's how that works. So if it was the other way around, if it was USD euro, it might say 0.8 or something like that. But yeah, that's what they are. Base and quote currencies. Base is the first currency in the pair, and quote is the second currency in the pair. the price you see on the chart is how many quoted currencies you'll get for the base currency. So you might see that the yen or the GBP JPY is like 194, 195 at the moment, which means that you'll get 195 yen for every single pound you get. And you go to the Euro USD, you'll see it's 1.2, something like that. That means you get $1.2 for every euro you have. Yeah, that's how that works. So now we understand how they're named, what the name means, and also what the price we see on the chart means as well. Okay, now we can actually get into how it works. So first of all, types of Forex pairs. So there's three main types of Forex pairs. There's major currency pairs, there's minor currency pairs, and there are exotic currency pairs. Major currency pairs are every single currency with the USD in it. So the Euro USD, GBP USD, USD JPY, and USD Swiss franc. Okay. Now, minor currency pairs. These pairs do not include the US dollar, but involve other major currencies such as the Euro GBP, the GBP JPY, which is what I trade, and the Euro AUD. So major currency pairs have the US in. Minor currency pairs do not have the US in, and there is something else called exotic currency pairs. Now, exotic pairs involve one major currency and one from a smaller or emerging economy. So you might get USD, I think there's MXN USD or USD MXN, which is the US against the Mexican. That's exotic. The USD TRY, which is the Turkish lira, whatever that is, or the Euro Swedish krona. These pairs tend to have wider spreads and are more volatile due to the fact that they have lower liquidity because no one really trades them. So there's major USD pairs, minor, which are not including USD, and then there's exotic currency pairs as well, which is like a major currency, so the GBP, the Euro, the Swiss franc, the USD, against an emerging economy currency. Okay, so they're the three types of pairs. So now what we've done is we've covered what the name means, we've covered what the price on the chart means, and we've also covered the three types of Forex pairs. So now we can actually get into understanding what it is and how it works. So the Forex market operates 24/5, which means 24 hours a day, 5 days a week, as a decentralized global marketplace where currencies are traded electronically. Major players include banks, institutions, corporations, and retail traders, like hedge funds, banks, like the central banks, and retail banks as well. But we'll get into that in a second. With prices driven by factors like interest rates and geopolitical events. So, interest rates, pretty self-explanatory that interest rates and geopolitical events are like earthquakes and that kind of thing. Trading occurs continuously across time zones, with participants profiting from currency pair price movements. It is a zero-sum game, okay? Which means that if you make $500, I made $800 today, that means collectively there's been a loss of $800. Now, this can come from 10 people losing $80. This can come from one person losing $800. This can come from two people losing $400. Whatever it is, whatever I make, it's a collection of losses for a group of people or someone else. So if you lose 500 and I make 500, I've won. You know what I mean? And then this is how it's zero sum. So it's like plus 500, take away 500 equals 0. So it has to just equal 0. And then what the broker is like you might lose $600 and I might make $600, but I'll actually get like 590 or something, and you might actually lose 610. The broker's made 200 there off the spread. So Forex market participants, two main types: institutional traders and retail traders, and these can be broken down into banks, governments, hedge funds, and retail traders. So there's institutional traders and retail traders. They're the two main types of traders. Then inside of the institutional traders, so like inside that genre, there's banks, governments, hedge funds, and then obviously on the other side of that, there's retail traders. Now, retail traders are people like us, which we'll get into in a minute. So retail traders are individual investors like me, you, the other guy, who trade Forex through brokers. They make up a small portion of the overall Forex market, but have become increasingly active thanks to advances in online trading platforms. Like 20, 30 years ago, you couldn't just go online and just trade Forex. And when you could trade Forex, or when you wanted to trade Forex, or were able to, you had to have, you didn't have leverage. You had to actually use 100,000, £1 million. They were the minimum. That was the minimum. 100 grand. But now, because there's leverage, because there's brokers, because obviously there's computers now as well, a lot more people and people of a lower class can trade Forex easily. But our focus, or retail traders' focus, is typically often on short-term price movements and technical analysis to capture profits. Whereas that's not really the case as much for most institutional traders, which are banks, both central and commercial. They're the largest players in the Forex market. Now, central banks like the Federal Reserve, the European Central Bank, and the Bank of England, the Bank of Japan, they influence exchange rates through monetary policy decisions, which we'll get into in a minute, such as setting interest rates and open market operations. Okay? So banks are the biggest players in the Forex market, and there's two types of banks. There's central and commercial. The central banks are the ones that actually release news and stuff like that, which can actually affect the currency for that bank. So the Federal Reserve will release some news about the USD, which obviously messes up all the markets, but mainly the USD. But commercial banks, they facilitate Forex transactions for corporate clients and individual customers, and often trade currencies on their own behalf for speculative purposes. So this is like Barclays Bank. If you've heard of Barclays Bank or HSBC or Lloyds Bank, you know the main ones. They'll trade, and you should know by now. Like, I think you've probably seen the advert of the guy calling Forex a scam. He used to work for Barclays and all that shit. Barclays trade Forex, and we'll get into how they trade it and all that stuff in the future. But for now, all you need to understand is that there's banks. They're the largest players. There's two types. There's centralized, who can actually release pieces of news which affect the markets as well as trading it. And there's also commercial banks, which they directly trade it, and they allow bigger clients to trade it as well. So let's say, like, it wouldn't just be like, today I wake up and I bought GJ and sold it at the same day, and then tomorrow I'll wake up and sell it and buy it the same day. It's like, I will call up Barclays, then I'll be like, can I put $1 million on this? Put $1 million on it, and then it's like, that's it for like a month or 2 months or whatever. But yeah, there's banks, there's governments as well. Governments engage in Forex trading primarily for the international trade and economic policy purposes. They use the market to maintain foreign exchange reserves and to stabilize their currency through interventions in the market. So when you'll see like a massive spike down, that could be considered an intervention. You'll probably heard of people calling it an intervention. Now, the Bank of Japan do this very, very often. They often intervene. And I think that's what started a massive move up a few months ago now. Back in May, I think May or June, they intervened, shot the price down or shot the price up, and then we just continued up after that. So yeah, they use the market to maintain foreign exchange reserves and sometimes do interventions. Governments may also influence exchange rates through policy decisions such as tariffs or sanctions. Like when Russia invaded Ukraine, obviously they got a lot of sanctions, and the USD, Russian, I don't know, I forgot the name of the Russian currency, but that shot down or shot up or something. It really, really was affected, primarily, obviously by the war, but then also because they were getting a lot of sanctions from a lot of different countries. Their exchange rate for every other country went down. That the value of their currency was very, very weak. It's got better now, actually. It's got actually quite stronger. It's stronger than it was beforehand, believe it or not. But hedge funds, right. Hedge funds are another form of institutional traders. Asset managers, investment firms often trade Forex to generate returns for their clients or to hedge against currency risk. So when you'll probably heard of hedge fund managers, or they just manage capital. They're like hedge funds. So you could probably put like £100, £1,000, £10,000 into a hedge fund. Now that can be for stocks and also can be for Forex, and I think now it's starting to be for crypto as well. So that's what, that's another form of institutional traders, and that's how hedge funds work. Their strategies may include long-term positioning rather than, short-term stuff, but they do trade that as well. They do short-term trades. Now, that's what the institutional traders are. We've gone over what retail traders are. So just going to do a quick recap of everything. So now we've discussed how the name on the Forex pair is formed, what it means, what the price on the chart means, what type of currency pairs there are, and who trades them. Now there's market makers, someone called market makers, and retail traders, okay? Market makers are financial institutions or brokers that provide liquidity to the Forex market by continuously quoting both buy and sell prices. They are always ready to take the other side of a trade, ensuring that there is always a buyer and seller available. But this, like for example, sometimes there might not actually be, without these guys here, there might not actually be a seller for GJ at like 2:53 a.m. something like that. Yeah, and that's why they'll increase their spread. That's why the price you pay to get into that trade is higher. But yeah, market makers are basically brokers that provide liquidity. They profit from the spread between the bid and ask prices. Now, these entities play a crucial role in ensuring the smooth operation of the Forex market by providing constant liquidity and reducing price volatility. However, some retail traders may see market makers as having a conflict of interest, since the market maker profits when traders lose in certain situations. Now, you probably heard of ICT and how market makers like all this shit, and you know, you got to trade against them, or you got to trade with them, and you got to trade against the retail traders. But the truth of it all, by definition, we're all retail traders here. You know what I mean? I think that's more of like a conspiracy theory / story than anything else. But this is what it is by definition, by fact. The market makers are the people who will make profits from you trading, basically, just you trading in general. Now, some can make profits from you losing because they'll hedge you, basically. They'll trade against you. But yeah, that's what market makers are. Now, retail brokers, which are a form of market makers, not retail traders, retail brokers, act as intermediaries. I can't really speak properly, but intermediaries, I think that's how it's pronounced. But retail brokers act as intermediaries between retail traders and the Forex market. They offer access to the market through trading platforms such as MetaTrader or proprietary software. Retail brokers can either be market makers, creating their own liquidity, or just general brokers, which are connecting retail traders directly with the interbank market. So that would be like Pepperstone, who I use, Oanda, those type of things. They're general brokers. But then there's also retail brokers as well. Now, brokers charge fees either through spreads or commissions. So that's referencing back to what I said before. When you get into a trade and you're automatically down, that's because they have the spreads and commissions. Now, I think most prop firms do commissions as well. But most brokers do spreads, really. But I think few of them, you can choose which one, but I think most of them is just spreads. Retail traders rely on brokers for executing trades, providing trading tools, and offering leverage, which allows them to trade larger positions than their bank account, than their account balance would otherwise permit. So when you go on, if you have a personal handy, so if you have a personal account, if you have a Pepperstone, Oanda, whatever, IC Markets, whatever it is, you're relying on the retail broker, or the broker in general, really, but typically retail broker, for executing trades on your behalf, and they also offer you the leverage. Like, when you think of, and a demo account doesn't really make sense, but when you have a real account, where do you think the leverage comes from? Like, because it's not centralized, like, it comes from the broker. Does that make sense? So they can offer you leverage, and they also execute trades on your behalf. Some of them have their own tools, like some of them have their own charts as well, which allows us to trade larger positions than our bank account would otherwise permit. Now we're getting into how Forex actually works, okay? So in basic terms, if demand for one currency is greater than another, then the price of the first currency will rise against the second. Like if the demand for the euro was greater than the demand for the dollar, the price of the euro will rise against the dollar. 1 euro will get you more dollars. This works the other way too. So if the demand for the dollar was higher than the demand for the euro, you'd get less dollars for your euros or more euros for your dollar. By the way, make sure we're liking the stream up, guys. It really does help me out. Let me know if there's any issues, by the way. Any questions we'll do at the end. But for now, just like the stream. Let us know if there's any issues. The following factors, which we're going to get into now, all feed into what influences supply and demand. Okay, so this is where things are going to get a little bit more complicated. We've gone over like the basic stuff of understanding everything about how it works on the charts, who trades it, what the names mean, what the charts mean, all that stuff. Now we are getting into how Forex actually works. Let me know if I'm going too fast, by the way, guys. But yeah, GDP, gross domestic product. We're going to start there. So, the GDP, or the gross domestic product, is one of the most important economic indicators used in Forex trading. It represents the total monetary value of all goods and services produced within a country's borders over a specific period, typically measured quarterly or even annually, sometimes monthly. And there's different figures as well. You can get M on M, which is month on month, Y on Y, which is year on year. And GDP is a key measure of a country's economic health and... sorry about that. Someone's at the door. GDP is a measure of country's economic health and performance, and it is closely monitored by Forex traders because it directly impacts a country's currency value. Just want to quickly say, guys, I got a wedding to go to. I've got my girlfriend's family around today, so if you can hear yapping in the background, it's them. But yeah, so there's girlfriend's family, but we should be okay. I've edited the mic. That's why I was a bit lower this morning, because I tried to lower it down a little bit so you can't hear our family. But yeah, anyway, GDP. We're not talking about weddings and girlfriends. GDP, gross domestic product. GDP is a key measure of a country's economic health and performance, and it is closely monitored by Forex traders because it directly impacts a country's currency value. Now, you might be saying here, like, why the fuck does this? Why do I need to know this? Like, why do I need to know any of this shit? Well, that's because it's not necessarily that you can then apply the data better, or you can, trade fundamentals. Now, it's more to just, if you understand something in its fullest, then you're gonna be better at it. You're gonna, if you know where you are, you know how it works, you know what's going on, you'll have more confidence because you'll know what's going on, which will obviously increase your trading. But you'll also know what's going on. Now, GDP is a key measure of a country's economic health and performance, and it is closely monitored by Forex traders because it directly impacts a country's currency value. How GDP impacts the Forex market. A rising GDP signals a growing economy, boosting investor confidence and increasing demand for the country's currency, leading to appreciation. Conversely, a falling GDP suggests economic trouble, prompting traders to sell the currency, which is causing depreciation. If a country's GDP growth exceeds expectations, the currency strengthens due to perceived economic strength. Let me know if I'm going too fast here, okay? But you want to be writing as much of this down as you can. Then at the end, you can summarize what you've written down. But let me know if I'm going too fast. Strong GDP may lead central banks to raise their interest rates, strengthening the currency, while a weak gross domestic product could prompt rate cuts or monetary easing, leading to country depreciation. Currency pairs reflect the relative GDP growth between currencies. If the US GDP outpaces the euros, for example, the USD may strengthen against the euro and vice versa. Inflation. Inflation is the rate of increase in prices over a given period of time. Now, this is probably one of the ones you've heard, probably one of the simple things that you've heard before. But inflation is the rate of increase in prices over a given period of time. When a central bank increases their interest rates, this fights inflation. When a central bank prints more money, this increases their inflation. If a bank does not increase interest and continues to print money, then inflation will skyrocket. If a bank increases interest rates and doesn't print... Hey bro, how you going? If a bank increases interest rates and doesn't print money, then prices will decrease and the economy will shrink. This is where it gets weird, right? Because the central banks have to find a perfect balance between interest rates and printing money to stop inflation going too high or too low. Okay? So inflation is one of the fun ones. I like to explain this one. It's quite fun. But inflation is a key economic indicator that measures the rate at which the general level of prices for goods and services rises, eroding the purchasing power of a country. So when inflation goes higher, this is, you can see this probably day to day in your life. A few years ago, milk probably like £1 on it, something like that. Today it's like 150, 190. That's not because, well, on the one hand, milk has got a little bit more expensive because of important goods and stuff like that. On the other hand, the pound has got weaker because inflation has risen because the banks printed more money. Okay? So the banks have to find a perfect balance between printing money and interest rates, which we'll get into soon. But central banks closely monitor their inflation rates and often adjust monetary policies to control it, which can have both short-term and long-term impacts on currency exchange rates. Okay? Now, how inflation impacts the Forex market. So high inflation weakens a currency as it reduces purchasing power, leading to depreciation. Central banks raise the interest rates to combat high inflation, which strengthens the currency, while lower rates during low inflation weaken it. Okay? Traders adjust positions based on inflation forecasts. Now, when I say traders, I mean institutional traders typically. Now, there's obviously going to be a few retail traders who hold long term, but typically this is going to be institutional traders who control the market. That's why you need to know this shit. But anyway, traders adjust positions based on inflation forecasts, with higher than expected inflation weakening the currency and lower than expected inflation strengthening it. If inflation exceeds central bank targets, rates may rise, boosting the currency, while low inflation can lead to rate cuts, weakening it. Currencies from countries with higher inflation generally weaken compared to those with lower inflation. Okay? So does this make sense? Inflation and currency pairs. Now, when trading currency pairs, traders often compare inflation rates between two countries. If one country has significantly higher inflation than the other one, its currency is likely to weaken against the other. For instance, if the US experiences rising inflation while the euro maintains stable inflation, traders might short the euro-USD pair, expecting the USD to weaken relative to the euro. Now, central banks. So these are one type of bank, which is a type of institutional trader. So central banks are a type of institutional traders, but these can control policies. A currency supply is controlled by central banks. Think of the Bank of England, the Bank of Japan, the Federal Reserve, etc. All these people, or all these banks, can announce measures that will have a significant effect on that currency's price. Central banks choose whether to increase or decrease interest rates. Typically, when a country chooses to raise the interest rates, the country's currency may increase in value. This is because it attracts foreign investors who want to benefit from the higher interest rates. When a country prints more money, the value of the currency drops. This will be explained in a couple of slides, but as I said before, the banks have to find a balance between increasing interest rates, which brings in the foreign investors, and also obviously printing money as well. Now, carry trades. Now, big banks and institutional traders will do this, and it involves selling a currency with a low interest rate, and this aims to capture the difference between the rates. So think of the yen. The yen is seen as a safe haven. They have historically had low or negative interest rates, and this is why price increases so much. It is seen as a safe haven. When most of the world is in an economic crisis, like we are today, the yen increases. Why? People will buy pairs like the GJ, which obviously pushes the prices up. But buying the GJ or buying the GBP is a method of selling the yen. Okay? So what big banks and hedge fund managers, whatever institutional traders, what they might do is they might take out a loan for the yen and then buy GJ with it, or they'll take out a loan for the yen, then they'll convert it to GBP rather than taking a loan out for the GBP. Why would they do that? Because the yen has less interest. There's less interest rates. The interest rates are lower, so they will take a loan out for the yen because of the low interest rates. Then they'll come over to Britain or UK, change it to GBP or USD, and then spend it, rather than just getting a UK loan. Okay? But sometimes they can just buy GJ and just buy it, kind of like gold. It's like a carry trade. Now, quantitative easing. The term quantitative easing is when the banks make more money. By quantitative easing, the central bank would be injecting more money into an economy, and this can cause a currency's price to fall in line with an increased supply. More supply, lower value. If I had the only, when I wrote this, because this slide is from a few months ago, but let's say I had the only lighter in the world, this perceived value would be a lot higher. But if this was one, which it is, one of like 10 billion lighters, like you can see, it's just a normal plastic one, the perceived value would be a lot less. If this was the only lighter in the world, it would not cost a pound to buy it. But because there's so many of them and it's so mass produced, the value is a lot lower. So think about this, right? When let's say this, okay? Let's say I became the most famous man in the world, and then I put my signature on this lighter. There's only one lighter then in the world with my exact signature on it, so the perceived value will be a lot higher. First of all, because I'll be the most famous man in the world, but also because it's one of one, okay? And that's how it works. The more supply, the lower value. That's just simple. But by quantitative easing, the bank would be injecting more money into an economy, which can cause the value to drop. Most people think that the banks actually print money when they do this, but that is not the case. Like a few hundred years ago, or not 100 years, like 50 years ago, something like that, then they maybe might print money, but now they can literally just edit, like they could just, go on this, edit the number, and change it from like 10 to 10 trillion. Central banks will use quantitative easing in order to control an economy's growth. During quantitative easing, the central banks will make more money and buy back their bonds with it. So when they buy back these bonds, this makes buying bonds for an investor safer, and therefore the interest return on buying bonds decreases. This, in a sense, forces investors to put their money elsewhere. So the typical thing is, I'm going to buy bonds, going to get property, get on the property ladder, all that shit. When you buy bonds, the interest rate is decided on how likely it is for that country to buy that bond back or pay off their debt. So if you go to, I don't know, fucking Syria and buy a Syrian bond, I don't even think that's a thing you can do. But if you go to Syria and buy a Syrian bond, the interest is going to be a lot higher than a bond just in the UK. Why? Because Syria, near enough a third world country, and the likelihood you'll get that back isn't very high. But yeah, the change on investment across the country will boost the economy. So if the UK didn't pay back their bonds ever, then weirdly enough, there'll be more people attracted to it, kind of, because the interest rate will be higher, okay? If they pay it off all the time, the interest rate gets lower. But how do they pay it off? They can print money. They print money, which lowers the value of the economy, or the currency. But then buying back the bonds with it changes the investor's methods. So instead of buying bonds, the investor will invest in a small business. It will invest in some guy. It will hire someone, something like that. And that's how it works. That's what quantitative easing is. So the central bank will print money, lowering the value, buy back bonds, increasing the value, and they kind of do that to kind of get more money into the system and grow the economy without actually causing any long-term damage. Does that make sense? Now, inflation, CPI. CPI, which we had yesterday, stands for Consumer Price Index, and it is a big fundamental that affects Forex pairs across the world. Pretty much every country has a CPI release once a month, near enough once a month. It tracks the price on a basket of goods, which is decided, weirdly enough, by the central bank typically over the course of a year. So we're going to use a corn example now. The next slide is going to be going over corn as well. But if corn was $1 last year and is now $1.03, then inflation is 3%. That's how they decide it. So they'll take corn, they'll take fucking milk, bread, eggs, the general stuff that you'll buy pretty much every time you go shopping, or grocery shopping. And then they'll measure the price of it last year compared to it now, figure out the percent, and that is the inflation. CPI is probably the biggest news release there is, and there are two forms. There's month on month and year on year. So there's month on month, so it's like the basket of goods last month was this much, and the basket of goods this month is this much, and they'll calculate the difference, and then obviously they do that for this time last year and this time this year. But big banks, institutional traders will keep a close eye on CPI because this helps them understand inflation for that country, and that helps them make informed financial decisions which affect the Forex market. And that is why we give a shit, because we need to trade like the big banks. We need to be on the same page as them, pretty much. We need to be doing what they're doing. Trying to trade against the big banks never really works. You can see an example of that with GameStop. If you heard of GameStop, if you heard of Wall Street Bets, you'll have heard of GameStop. Basically, we traded everyone who joined in, traded against the big banks, and that's why the big banks lost billions. But then they'd do pauses, they'd do all this, that, and they can manipulate it very easily. The easiest way to do it is just trade with the big banks. Like with GameStop, everyone was like, the big banks are shorting it, but instead of shorting it, they bought it and got billions and billions of people to buy it, and the banks lost billions. But if you decided to short it, typically it would be a lot easier to make money because that's what the big bank is doing as well. So think of it like this. Think of it like, I don't know what I think it's like a mussel or something, or an urchin. You know, in the sea, you have these things that go on whales. Like the big banks, the institutional traders are like the whales, and we're like the little fish that cling onto the side of them and go the same place as them, and get traveling with them, shit like that. But yeah, that's how that works. Our goal is to basically trade with the big banks. That's why we care. But big banks and institutional traders will keep an eye on CPI because this helps them understand inflation and makes them informed, or helps them make informed financial decisions which affect the Forex market because they trade with such massive amounts of numbers. Now, interest rates. So an interest rate tells you how high the borrowing cost is or how high the rewards are for saving, which is technically lending people. So it's the interest rate. It's like, this is how much you'll get for lending, and this is how much you'll get for borrowing, like lending out. If you're a borrower, the interest rate is the amount you are charged for borrowing the money, shown as a percentage of the total amount of the loan. The higher the percentage, the more interest you have to pay back, and the more expensive the loan is. Yeah, if you're saving money, you're giving the bank your money, and they're loaning them. They're lending your money off of you, so you get the money from them. The savings rate tells you how much money will be paid into your account as a percentage of your savings. The higher the savings or the interest rate, the more that will be paid to you. Even a small change in interest rates can have a big impact, so it's important for institutional traders to keep an eye on whether they rise, fall, or stay the same. And this is why interest rates announcements can heavily impact a currency pair at the time that it comes out, because there's a lot of traders anticipating it. And there's a lot of there's a lot of retail traders gambling, and there's a lot of big traders actually anticipating it so they can close their massive positions. So, why do interest rates affect a currency? Interest rates affect a currency by influencing investment flows. Higher interest rates attract foreign investors seeking better returns, increasing demand for the currency and causing it to appreciate. Lower interest rates do the opposite, okay? Driving investors away because they don't want to loan from it, reducing demand and leading to currency depreciation. Traders also use strategies like the carry trade, which we just went over, borrowing in low rate currencies to invest in higher rate ones. So they'll take a loan out for the yen because it has lower interest rates, but they won't invest in it because it's got lower interest rates. Does that make sense? They won't invest in Japanese businesses because the interest rates are lower, so they won't get as much money back. Or they won't give out loans in Japan because they don't get as much money back. But they'll take a loan willingly in Japan because the interest rate is lower. Then they will convert it to GBP and invest in that. Then they'll get the high interest rate, make a profit there, change currencies. And this is where I was telling you about how sometimes people can wait for the best time to trade to exchange their currency. Like with me, and I sell things in USD. I convert it to pounds into my bank account. I could wait for the best time. That's how that kind of works. So a carry trade, or what traders would do, is they'll go to a low interest country, take a loan out, convert it to GBP, give a loan out or invest it there, get nice interest, get a nice income from that, not have to pay much interest. Then what they could also do is wait for the best time to trade. So they could take it out. They could take out a loan when GJ is at its highest and then change it to GBP. Then wait for it to go down and change it back. Wait, no, the other way around. They could do it when GJ is at its lowest, take a loan out at its lowest, then wait for it to go to its highest, change it back, and then they don't have to pay as much back to the loan, technically. So that's how interest rates affect a currency. Central banks adjust interest rates to manage inflation and economic growth, which further impacts the currency's strength. Now, this is where we kind of tie all those things together. Now, you might have been floating around thinking, like, what the fuck is going on? Like, why do I care about that shit? This is going to be bringing all that stuff together. So imagine corn costs $1 a pound, okay? And everyone makes $100 a month, and each month everyone buys £100 of corn. Then the government prints more dollar bills and gives everyone $100 more per month in order to grow the corn economy. How does that grow the corn economy? because then everyone would spend the extra $100 on corn. So instead of spending $100 on corn, they're spending $200 on corn. So the corn producers are making double the income. The demand for corn in the economy would go up because people want more corn, and the corn economy would grow because they'd have to hire more people, build bigger farms, build bigger factories, build bigger packaging things, all that shit. They can spend more on ads as well. But everyone gets $100 more, which is printed by the government, which goes to the corn economy, which grows the corn economy. Okay? But because of the demand increase, the price will also increase. Now you would have to give up more money for your corn. This, roughly speaking, is what inflation is. You're getting less corn for every dollar than you used to because the bank printed more money and gave you more money and you spent that money on corn. So the corn price went up. But you want to spend So now let's say, because corn, the price of corn skyrocketed, cost of living crisis, you can't buy as much corn as you could a few months ago. But you want to spend $300 on corn, okay? So you'll take out a loan of $100 and everyone else will as well, and they'll all buy more corn with it, okay? If everyone did this, then they're spending, instead of spending $200, they're spending $300 a month on corn. Think about that. The economy would grow. Again, to fight the increase in the price of corn, what the bank can do is raise the interest rates. And this means that people will take out less loans. So let's say the price of corn went up, everyone took a $100 loan out, then the interest rates went up and everyone was like, oh, I'm not going to pay £7 interest on this $100 loan. So I'm going to put that loan back. I'm going to avoid taking out loans. I'm going to go back to spending $200 a month, which then lowers or shrinks the demand for corn, which lowers the price for corn, which lowers technically inflation. Yeah? So if the bank raises the interest rates, people will take out less loans. And they'll also have to pay more for their mortgages. And they'll be more inclined to save the money because they get more interest rates from it, or more interest from it. This decrease in loans and spending and increase in savings will decrease inflation because it decreases the demand, decreasing the growth of the corn economy. So that is basically rounding everything up. I used corn as an example because it was the first thing I could come up with, but why does the bank have to print more money? Well, in general, issuing new money is designed to provide the economy with liquidity. For example, it creates incentives for consumption and access to finance, which promotes industrial growth, as we've just gone over with the corn economy. Economic development and innovation. In general, properly issuing money is linked to economic expansion, as I've just explained. Now, that wouldn't just obviously be with one thing, it would be with everything. Okay, so they print more money, give it to everyone, everyone's spending more on everything, so the price of everything goes up. But using the corn example, the government will print money, which will increase the money people have to spend on corn, which increases the price of corn. This increase in demand and price means the corn businesses have to hire more people, which increases the economy because then there's more jobs being offered and also more money being made, which attracts investors and increases their stock of corn. This is healthy and controlled growth, and it expands the economy. Now, fiscal policies, that's what we want to discuss next. Fiscal policies, that's what I was trying to talk about this morning, but I couldn't remember the name for. Fiscal policies. A fiscal policy is the method by which governments adjust their levels of spending and taxation to directly influence the economy. A government gets its income from all different types of taxes: income, sales, corporation, any tax you can think of. That's what the government makes their money from. It then spends money on services like the police, healthcare, benefits, and the educational system. They will also sometimes invest in things like bridges, airports, and tunnels. Like the council, the government in Liverpool might invest to build a massive new airport and get rid of the John Lennon one, something like that. Kind of like that. But they'll also pay for the police, they'll pay for the healthcare, they'll pay for the benefits for people, like the people who can't work or don't work, they'll pay for those benefits, and the educational system as well. Now, there are three main types of fiscal policies, and there are different ways governments can go about doing each one. So, neutral. There's a neutral fiscal policy is government spending is roughly equal to its revenue. Equal spending, equal taxes. So they make $1 million, they spend $1 million. Neutral. Expansionary is when the government is spending higher than its revenue. Higher spending, less taxes. So they might spend 1.2 million where they're only getting 1 million. So there's a $200,000 deficit there. Then there's contractionary, which is government spending is lower than its revenue. Lower spending, higher taxes. Now, you may have heard, if you follow the politics in the UK, you may have heard of Labour and Tories. If you've heard of this, you've probably heard of how the Tories had a 22 billion black hole that was left for Labour, whatever that is. But anyway, that means they went from an expansionary policy to a contractionary policy because they have to spend less because they're paying off these debts. They're getting more money from taxes and they're paying it off into the debts. That's why the prices of things are starting to go back up again. Now, how fiscal policies affect a currency. Let's say we had an expansionary fiscal policy, which is higher spending and less taxes. The budget deficit resulting from an expansionary fiscal policy needs to be financed. This can be done through the printing of fresh currency, public borrowing, or overseas borrowing. Each one of these methods has a different impact on the economy. Printing fresh money. The printing of fresh money can increase inflation. As we've discussed, you should know this now. It should be second nature almost. Printing fresh money increases inflation, having a downward impact on interest rates. This obviously would lead to depreciation in the value of the nation's currency against other currencies. So, this is the negative version of expansionary. Now, filling this deficit can be beneficial as well. Public borrowing. The method of financing the fiscal deficit can lead to an increase in the interest rate in the economy and would attract foreign investment in government paper and is likely to lead to an appreciation in the local currency. But this can also, I think there's a negative about this one, which we'll discuss now. So foreign borrowing. The impact of funding a fiscal deficit via foreign borrowing would lead to monetary expansion as money from outside the system is entering in. This is likely to have a softening impact on interest rates, leading to depreciation in the local currency. However, the inflow of foreign currency being used to finance the fiscal deficit is likely to pressurize the local currency to move upwards. Thus, the immediate net effect of financing a fiscal deficit via foreign borrowing may be balanced out as substantiated above and may not lead to a major change in the value of the local currency. So it's not positive, nor negative. Okay? Make sure you're getting this down, guys. Now, impact of global events. So, geopolitical events, as we discussed at the very start, wars or instability, cause currency depreciation due to increased risk. Natural disasters disrupt economies, weakening currencies short term. Now, economic crises drive investors to safe haven currencies like the yen, weakening riskier ones. Pandemics disrupt economies, leading to currency volatility. Like we've seen at the very start of COVID, you will have seen you would have seen on the stock market, price absolutely shot down, all the way down, then went up and made all-time highs. That's volatility in a nutshell. Now, trade wars and sanctions can hurt exports and foreign investment, causing currency depreciation, like what happened with the Russian currency. When they got sanctions and they had wars and also trade wars, the value of their currency completely dropped. Now that they're not relying on the other countries, it's starting to go back up. It's actually higher than it was beforehand, or at least it was about 6 months ago. But central bank actions in response to global events, like interest rate changes, directly affect currency values. And now we are coming to the end. So, let's just take a deep breath. Right, okay. Sorry. The Bank of Japan's calling me. But I'm going to fucking leave it. So, a Forex pair is basically a tug of war between two central banks and their economies. Let's say institutional traders were looking at the Euro USD. They wouldn't look to see if there's a fair value gap on the daily chart. Some might, most of them won't. They'd look at both economies and then buy and sell based on that. That's why we need to care about this stuff. Because our job is to cling on to what they're doing. Regardless of if we see fair value gaps and all that shit, we basically need to be selling in the same direction as them. Now, if the European economies, a combination of all the European countries, had a better outlook than the American economy, they'd buy the Euro USD. This would increase the amount of dollars you get for each euro, and vice versa. If America was looking better than Europe, then they'd sell the euro USD, which means that you'd get less dollars per euro. And that is how Forex works. Its long-term movements are decided by big investors who look at the outlook of two economies, and the outlook is decided by all of the pieces of, or pretty much all of the information I've shown you today. Okay? So if there's any questions, you can either ask them now. We're going to sit here for like 2 minutes. You can either ask them questions now, or you can DM me privately if you don't want to ask them here. But that is the end of this. There is nothing else to discuss. I hope that makes sense to you all. But yeah, we're at the end. I hope you've learned something. I hope you've been making notes. And now I also hope that you're going to go and summarize those notes so you can fully understand on a deeper level exactly what I was talking about. Summarize your notes, see what's going on, make sense of it. If you can't make sense of it, ask in the Discord, ask me, whatever it is. But this is, as I said, this isn't how you're going to become a millionaire. You don't necessarily need to know this, but it helps. It really does help. Look at me. I'm telling you, it's helping, and look at where I am. So, but yeah, that is it, guys. It doesn't seem like anyone has any questions, so we're just going to head out now. We literally just got to the hour mark as well, which is perfect timing, I guess. But that is it. I have nothing else to say. That is how Forex works. I hope that makes sense to you. If it doesn't, it's important that you ask it. And if you have any questions, DM me. No problem, Terry. Happy to help. And that is literally it, guys. All I ask is just like the stream. Not as many people here as I thought there would be, simply because this does seem quite boring, and I know it's probably been, you probably yawned a few times, you probably fell asleep. But we move. It is what it is. The people who don't care are going to be the ones struggling. Simple as that, guys. That is it. I'll see you guys tomorrow. Not tomorrow, on Monday, 2:30 p.m. BST for the free New York stream. Have a good weekend. Make sure you review your journals. Make sure you're doing something admin-y, like the back-end stuff, that can progress you towards your trading goals. Make sure to review your journal. Maybe do some back testing. Maybe even go out and do some exercise, because that increases your mental health. Eat healthy. Don't go out drinking, please. But I'll see you guys on Monday, okay? Take care, guys. Have a good rest of your week. Have a good weekend. You've deserved it. You deserve it. And I'll see you guys on Monday, 2:30 p.m. BST for the New York